Hello and welcome to Impact Tuition. We continue our discussion on accounting standards that deal with tangible non-current assets within the scope of the ICA Ghana Financial Reporting Syllabus. We will discuss IAS 20, accounting for government grants and disclosure of government assistance. Governments would usually provide money or some incentives to companies to export their goods or to promote local employment. And so this standard IAS 20 prescribes the accounting for and disclosure of government grants and other forms of government assistance. Government grants could be revenue grants or capital grants. Example of revenue grants: contribution towards payroll costs, and in capital grants, government could provide some assistance to businesses towards the purchase of non-current assets. Right. Let's look at some general principles. IAS 20 follows two general principles. The first is the Prudence Principle. Here, grants should be recognized only when it is reasonable that the entity will comply with the conditions attached to the grant, and there's reasonable assurance that the grant will be received. So, per this principle, recognize the grant if the conditions attached to the grant will be complied with. And there is reasonable assurance that the grant will be received. This is the first principle. The second is Accruals Principle. What does this say? The grants should be matched with the expenditure towards which they were intended to contribute. The grants should be matched towards the expenditure grants should be matched with the expenditure towards which they were intended to contribute. What does this mean? This means that if you received a grant to help in the purchase of a non-current asset, you should match that grant to that purpose, because that was the intended purpose for the grant. So these are the general principles, the accrual principle and then the prudence principle. Let's look at some definitions. Government grants. These are assistance by government now. They could be in the form of transfer of resources, to an entity in return for past or future compliance with certain conditions relating to the operating activities of the entity. So that is government grant, an assistance by government in the form of transfer of resources to an entity in return for past or future compliance with certain conditions relating to the operating activities of the entity. So government could provide a grant to a business for complying to past conditions or complying to future conditions. And these conditions must relate to the operating activities of the entity. Now, grants could relate to assets. So grants related to assets are government grants. whose primary condition is that the entity qualifying for them should purchase, construct, or otherwise acquire long-term assets. If the grants relate to assets, the primary condition is for the entity to purchase, construct, or otherwise acquire a long-term asset. For grants related to revenue, the standard says these are grants other than those relating to assets. So these are grants other than those relating to assets. So if an entity receives grant and the primary condition is not for the entity to purchase, construct, or otherwise acquire a long-term asset, then that grant is obviously a revenue grant or grant related to revenue. Right. Let's dig deeper into the treatment of these types of grants. Revenue grants. Revenue grants. Revenue grants. The recognition of the grant will depend on certain circumstances. Revenue-related grants will be recognized if the grant is paid when evidence is produced that certain expenditure has been incurred. So the first thing, the conditions are either in the future, which the entity is yet to comply with, or the entity has already complied with those conditions in the past. Now, if it is a revenue grant, if the grant is paid when evidence is produced that certain conditions, that certain expenditure has been incurred, that grant should be matched with that expenditure. So now if the entity has incurred certain expenditure and they've provided evidence and the grant is paid, that grant should be matched with that expenditure. So the grant should go to reduce what the entity has already incurred for that expenditure. If the grant is paid on a different basis, example of which could be achievement of a non-financial objective, that grant should be matched with the identifiable cost of achieving that objective. Now, an example of such non-financial objective should be the creation of a specified number of new jobs, say for fresh graduates. If the entity is or has been able to achieve that objective and as a result has received grant, that grant should be matched with the identifiable cost of achieving that objective. All right. So these are the conditions under which a revenue grant will be recognized. Next, we'll look at the presentation of revenue grants. Presentation of revenue grants. Now, IAS 20 allows two methods. The one is that the grant is presented as a credit in the statement of profit or loss. Or the other option is that the grant is deducted from the related expense. All right. Going by this option, which is the first one, where the grant is presented as a credit in the statement of profit or loss, the grant will be recognized as an income, and in the credit side of the profit or loss, and the expense will be recognized as an expense, or the expenditure as an expense in the debit side. So the net effects will be seen. Or you deduct the grant from the related expense and then just recognize the remainder of the expense under expenses in the statement of profit or loss. All right. Right, let's look at this illustration. An entity is given 300,000 Ghana cedis. Ghana cedis, and the condition is to keep staff employed within a deprived area. The entity must not make redundancies for the next 3 years. Good. This is an example. An entity is given 300,000 Ghana cedis to keep staff employed within a remote area. Now the condition is that there should be no redundancies for the next 3 years, or the grant will be repaid. Every grant comes with conditions. The conditions can be past or future, but this is obviously conditions to be met in the future over the next 3 years. But the entity has been given the whole grant amount now, which is 300,000. So how would the entity account for this? Since the entity hasn't met all the conditions, the 300,000 will be held in a deferred income account. And then at the end of every year, a portion of the 300,000 will be transferred to the income statement when the condition is met. Spreading 300,000 over 3 years will be 100,000 at the end of each year. So in the first year, in year 1, 100,000 is taken to the profit or loss. Now this 100,000 can be shown as a separate line item or deducted from administrative expenses or from the staff costs. Then the remainder, now you have 200,000 in deferred income. And this will be shown as a current liability in the statement of financial position. All right. So this is how the grant to be accounted for. At the end of year 1, 100,000 will be recognized in profit or loss as a separate line item, or it can be used to reduce administrative expenses or deducted from the staff cost. So we have our deferred income account. Let's see some double entry. When the whole 300,000 was received, let's say bank 300,000. This is our deferred income. Now at the end of year 1, 100,000 is sent to profit or loss. Sorry. At the end of year 1, deferred income 100,000. You could present it this way as a separate line item under income, or deduct it from the related staff cost or administrative expense, like this. Now we will have at the year end of 200,000. This is at the end of year 1. Going into year 2, our balance brought forward is 200,000. Now in the statement of financial position, there's 200,000 here will be shown as deferred income under liabilities. We do the same for year 2. We transfer another 100,000 to the profit or loss account. Year 2, deferred income 100,000. We have our balance. No. The balance carried out at the end of year 2 is 100,000. 200, 200. Now we come into year 3, and the balance brought forward is 100,000. At the end of the year 3, we transfer the 100,000 to profit or loss. Now this 100 will be held under current liabilities because it will be paid within the next 12 months. So when the year ends and we've complied with the conditions, we transfer 100,000 to profit or loss. We do the same over here, 100,000. This is for year 3. So we can see that the whole 300,000 is spread over a 3-year period when the conditions attached to the grant are met. So at the end of year 3, the deferred income account is 0, and we recognize the whole 300,000 over a 3-year period when the conditions attached to the grant was met. This is the double entry for revenue grants and how it is treated. We move on to capital grants. For capital grants, we have said earlier that these are grants that contribute towards the purchase of non-current assets. So, IAS 20 permits 2 treatments as well. The one treatment is to write off the grant against the cost of the non-current assets and depreciate the reduced cost. Write off the grant against the cost of the assets. And the second treatment treats the grant as deferred credit and transfer a portion every year to revenue so reducing or offsetting the depreciation charge. On the original cost. Using the first method, whatever grant you received, use the grant amount to reduce the cost of the asset and depreciate the reduced cost. So, if you bought an asset for 100,000 Ghana cedis and you received a grant of 10,000, reduce the cost with the grant, and then you have a reduced cost of 90,000, and that will be the cost at which you recognize the asset in your books and depreciate. The second option is much like the first one we have already done. You would treat the grant as a deferred credit, and at the end of every year or at the end of the year, you spread the grant over the useful life of the asset and transfer a portion every year to the profit or loss as revenue to reduce the depreciation. The net effect is the same, just that for one, the grant is spread over the useful life, and the other, it is taken out and then the reduced cost is spread, which is the same in a sense. Alright. Now comparing the two, method 1 is obviously very easy to operate. But method 2 has the advantage of ensuring that assets acquired at different times and in different locations are recorded on a uniform basis, regardless of changes in the government policies. Let's pick an example to test our understanding of capital grants. An entity opens a factory and receives a government grant of 15,000 in respect of capital equipment costing 100,000. So entity opens new factory and receives government grant of 15,000 relating to capital equipment costing 100,000. Now the entity depreciates all PPE at 20% straight line. Now we are required to show the statement of profit or loss and financial position extract. In respect of the grant in the first year under both methods. All right, let's begin. We have two methods. The first method is to deduct the grant from the cost of the asset and then depreciate the reduced cost. So our solution is presented in this manner. Method 1, where we reduce the cost of the assets by the grant. The cost of the asset is 100,000. The grant is 15,000. So the reduced cost becomes 85,000. Our depreciation charge for the year is 85,000 times 20%, which is 17,000. Then in the carrying amount is 68,000. We are told to prepare an extract for profit or loss. So profit or loss extract. Depreciation, sorry, 17,000. Ghana cedis. As an expense. Then in the statement of financial position extract, we have the cost of the asset to be 85,000. We already have our workings here. And then accumulated depreciation is 17,000. Then the net book value or the carrying amount of the asset is 68,000. Now, this is all for method 1. We use the grant to reduce the cost of the asset, and then we depreciate to get depreciation charge for the year and then our carrying amount. In our profit or loss, we show the depreciation for the year 17,000. Then our statement of financial position extract the cost less accumulated depreciation, giving us our carrying amount of 68,000. This is method 1. We continue to method 2. Where we treat the grant as deferred income. Deferred credit. Over here, this is our depreciation charge. The depreciation charge is 100,000 times 20%, which is 20,000. The grant will be received into a deferred income account. Grant received 15,000. Now 20% is like 5 years. 20% is 5 years. Yes, so we divide the grant into 5, or we find 20% of the grant. So year 1, 20% of 15,000 is 3,000. What is our balance brought down at the end of the year? Balance carried down, closing balance is 12,000, giving us 15. Now this becomes the opening balance for the second year, 12,000. Okay, now let's do the presentation. Our profit or loss extract would have depreciation, have a depreciation of 20,000, and then the government grant transferred from the deferred credit account of 3,000, and in a statement of financial position extract, we would have on current assets, plant and machinery. The cost is 20,000. Accumulated depreciation of 20,000. Carrying amount is 80,000. We move on to non-current liabilities. On current liabilities, the carrying amount of the government grant is 12,000, but a portion of the 12,000 will be paid in the next 12 months, and the rest in 2 years' time. So we are going to split the non-current assets, which is the carrying amount of the deferred income, into the portion that will be paid in the next year, which is now current, and then the portion which is non-current. So the balance sheet extracts non-current assets. We have government grants, which is 9,000, which is non-current. In our current liabilities, as well, we will show government grant, and we have 3,000 to show the portion which will be transferred in the next year. Right. This is it. Using the deferred credit approach, we find our depreciation on the costs, which gave us 20,000, and then we prepare the deferred income account, where the whole grant received is credited, and then a portion transferred to profit or loss at the end of every year. So this is our grant received, 15,000. 20% of it is 3,000, and this 3,000 is transferred to the profit or loss at the end of the year to reduce the depreciation. And the net effect is 17,000, as was realized using the first method, but different approaches. And our statement of financial position extract, the non-current asset has a cost of 20,000. The accumulated depreciation charge for the year here, 20,000. The current amount is 80,000. Now we need to separate the deferred income's carrying amount into non-current and current, where the current is what will be paid in the year we are entering, which is year 2, and then the non-current portion is for year 4 and 5. No, year 3, 4, and 5. So 3, 4, and 5 is 9,000 here, and then what will be paid in the next year, which is year 2, is now current, so 3,000. The addition will give us the 12,000 as we had here as the carrying amount. So this is it, the treatment for both revenue grant and capital grant using both methods. Let's end our discussion with repayment of grants. Repayment of grants. In some cases, grants may need to be repaid if the conditions of the grant are breached. Like in our illustration, we're told that the entity shouldn't lay anybody off for the next 3 years. If the entity lays a worker off, they are in breach of the conditions, and they may be required to repay the grant. Now, if there is an obligation to repay the grant and the repayment is probable, then it should be provided for in accordance with the requirements of IAS 37. So, if the entity is in breach and they are required to repay, Now, if there is an obligation to repay the grant and the repayment is probable, then it should be provided for in accordance with IAS 37. Now, IAS 37 is provisions, contingent liabilities, and contingent assets. If you are in breach of the condition, there's an obligation to pay, to repay the grant, and that repayment is probable. You should make a provision for the repayment in accordance with the requirement of IAS 37, which is provisions, contingent liabilities, and contingent assets. We have a video on this as well. You can check it out. If the deferred income method for capital grants has been used, then the remaining grant should be repaid to the government. So if the deferred income approach is used, the remainder in the deferred income account should be repaid to the government. Like we did in our illustration, the grant is held in a deferred income account, and whatever was transferred in the year means that the entity has complied with the conditions. What is in the deferred income account means that the entity is yet to comply with those conditions. So if the entity is in breach, whatever is in the deferred income account should just be repaid to the government. It's as simple as that. If the netting off method for capital grants has been used, then the cost of the asset must be increased to recognize the full cost without the grant. So if net off for capital grant, the cost of the asset should be increased. To the full cost without a grant. Then a liability will be set up for the grant repayment. Right, and with this we bring our discussion on government grant to a close. We go over the repayment of grants. If there's an obligation to repay the grant and the repayment is probable, then we should make a provision for the repayment in accordance with the requirement of IAS 37, provisions, contingent assets and contingent liabilities and contingent assets. We have a video on this. Kindly check it out on Impact Tuition YouTube channel. If the deferred income method is used, whatever is remaining in the deferred income account should be repaid to the government. If the net off for capital grant was adopted, the cost of the asset should be increased to reflect the full cost without the grant, and a liability will be set up for the repayment of the grant. Kindly like this video, subscribe to the channel, and recommend our channel to those friends who will be in need of these tutorials. Thanks for watching, and see you in our next video.